What would be worse? Spending £200,000 on a property today and its value plummets by £20,000, or don't buy the house, the market booms and it goes up by £20,000 in record time? Well, at the moment in the UK, there are thousands of people asking themselves that question. They're sitting there waiting, unsure of what to do and whether the market will boom or bust. But having personally invested through cycles with some big peaks and troughs, I promise you, this uncertainty is very good news for serious investors. So in this video, I'm going to show you what's actually happened to house prices over recent years, how this is going to affect us this year, and the strategy that serious investors can use to take advantage of this. So in order to understand what's happening now and how best to invest, we need to go back to 2022. During the pandemic, borrowing money was basically free. And as things opened up and it was clear that the world hadn't ended, there was a massive rush of new buyers into the market. Demand was high and supply was low. So the average UK house price flew up to £273,000. However, almost overnight, interest rates then shot up from 0.1% to 5.25%. And suddenly, buying that holiday home on the coast became less interesting. And first-time buyers who'd been frantically saving found that their dream home was now out of reach. So the market switched overnight. And we all know what happens when demand suddenly drops like that, right? A huge crash in prices. Well, not this time. House prices stayed virtually the same, falling no more than 5%. So what the hell happened? Well, although prices appeared stable, inflation was running at close to 10%. A house may have held its value, but was suddenly cheaper relative to rents, wages, groceries, anything else you can think of. So although we didn't hear about it, inflation-adjusted prices actually fell by 15% in 18 months, which is the biggest drop since 2008. In other words, we had a silent crash in 2022 that most people never heard about. However, if you're subscribed to our newsletter, you would have been aware of it. So if you want to stay on top of UK house prices and investment tips, you can sign up using the link in the description. And then let's move on to 2024, which brought more surprises for us. Labour came into power, new property regulations were expected, and mortgage rates stayed stubbornly high for longer than most people had expected, which caused lots of nervous investors to start selling their properties, and all the experts predicted a crash. But then something unexpected happened. House prices went up. Halifax reported a 4.8% increase in 2024, pushing the average UK house price to a record £300,000. So why didn't the market crash as expected? Well, firstly, as we just saw, you could say that prices had already crashed in 2022. But because the actual price tag didn't change, no one got pushed into negative equity. And because so much of the property market is psychological, there was none of the panic that you'd get in a market where inflation was zero and property prices fell by 15%. Secondly, people got used to the higher mortgage rates. With most people on fixed rate loans, they had warning and time to prepare for their costs to go up. So even though the increase was dramatically fast, the impact was delayed. This explains why in countries like Sweden, where most people are on variable rate loans, the immediate impact saw property prices fall a lot further. Thirdly, the UK has a housing shortage and the population was growing fast. With no forced sellers and lots of desperate buyers, many of whom were stuck in the rental market where rents were rocketing upwards, prices are more likely to hold steady. And fourthly, the economy itself remained steady. We didn't have a financial crisis and unemployment remained low. So most people were still earning enough to afford their homes. And since there was no sudden economic shock, there was no reason for house prices to collapse. So if house prices silently crashed in 2022, and then ticked upwards against all the odds in 2024, does that mean we're now about to see a boom, a bust, or something in the middle? And most importantly, what should we do as investors? Well, let's start with the sentiment. On the one hand, you can look at the market and think, if property prices haven't fallen after what we've been through these last few years, they're never going to fall. Now, interest rates are coming down, there's a huge supply-demand imbalance, and ever higher rents make people desperate to jump onto the property ladder, whatever it takes. On the other hand, maybe the market is like Wile E. Coyote. It's already walked off the edge of the cliff and is suspended in midair. And any minute now, people are going to notice and we'll see prices plummeting. With the economy looking weak, a small increase in unemployment could be enough for the bubble to burst. So, which is it? Well, with that weak economy and interest rates staying high, it's hard to spot any indication that we're about to head into a boom. But at the same time, I find it hard to imagine a crash. Headline property prices might look expensive, but after adjusting for inflation, prices are at the same level today as they were in 2013 and 2003. You tend to get a crash after property prices have raced ahead of inflation. People get overexcited, bid prices up, the market goes crazy, then reality bites. You can clearly see that on this chart. Prices raced ahead of inflation in the late 80s and the mid 2000s, which set up the crashes that followed. Look at the most recent part of that chart, and you can see that prices have been falling relative to inflation. Could we get a crash from here? Absolutely, it's possible, but it doesn't seem likely. So, as far as we can tell, with a whole team of people out in the market every day talking to developers, lenders, and investors, in 2025, we're entering what I call a stealth growth phase. This is where prices don't explode upwards or crash downwards. They just steadily climb by 3 to 4% per year. Maybe in line with inflation, maybe a little bit ahead. And that is what most mainstream forecasts are predicting. 20% growth by 2029, which is roughly 3.7% per year. Now, that doesn't make for exciting headlines, but it is an exciting time for investors. And I'll explain why by going back to our example from the beginning. Let's say you put £50,000 down as a deposit on a £200,000 property in Manchester. Even if prices only grow by 3% per year, in 5 years, your property will be worth £232,000. That's £32,000 in capital growth. So you are making a double-digit annual return on your money, plus all the rental profit you've collected. Now, as I mentioned, this type of growth won't make the headlines because it's not exciting. But these stealth periods are the safest times for investors, because by using a mortgage to give yourself leverage, you can rack up some great returns without the risk of buying in a hot market and seeing prices collapse shortly afterwards. However, even when the market is steady, there are ways that you can manufacture your own boom, and that is to buy in the right place at the right time. Because if you'd bought in the best performing town in England last year, you would have had growth of 3 times the UK average. So if you want to see which high growth areas we'll be investing in this year, check out this video next.